Hello everyone, I am Leah Maica de Castro. Today, we'll talk about the cash flow statement. It is one of the three main financial statements. First, income statement. It provides information on the revenue and profit over a certain period of time. And balance sheet gives a snapshot of financial situation or financial health. But it is the cash flow statement where you can find out how effective a business is in managing this cash and what it spends on. Philippine Accounting Standard 7, Statement of Cash Flows. Learning Objectives. Describe the statement of cash flows. Differentiate between the operating activities, investing activities, and financing activities. State the classification of the following in the statement of cash flows: dividends received, dividends paid, interest paid, and interest received.
So now we are going to talk about the PAS 7 Statement of Cash Flows. PAS 7, it requires an entity to present a statement of cash flows as an integral part of its primary financial statements. Statement of cash flows is a financial statement that summarizes the amount of cash and cash equivalents entering and leaving a company. It also measures how well the company generates cash to pay its debt obligations and fund its operating expenses. We have three definitions of terms here. First is cash. It comprises cash on hand and cash in bank. Next, cash equivalents. These are short-term, highly liquid investments that are readily convertible to known amounts of cash. And lastly, cash flows. It includes inflows and outflows of cash and cash equivalents. The cash flow activities are majorly classified into three categories. They are operating activities, investing activities, and financing activities.
The first one is the cash flow from the operation. The most important part because it shows you how much cash is generated with the actual operation of the business, meaning by selling the company's products and services. Then, we have the cash flow from investing activity. This is a cash spent on investment or cash received from sales of investments. In other words, it outside the primary business activity of selling products and services. Last one is the cash flow from financing activity. This section summarizes cash transactions that involve raising, borrowing, and repaying of capital.
So, in remembering the classification of cash flows, we just have to remember the accounting equation, which is the assets is equals liabilities plus equity. It is an operating activity if it affects current assets and current liabilities of an entity. And it is an investing activities if it only affects the non-current assets. And lastly, it is a financing activities if it affects the non-current liabilities and equity of an entity. The statement of cash flows is prepared using cash basis. Under the cash basis of accounting, income is recognized only when collected, and expenses are recognized only when paid, rather than when these items are earned or incurred. Accordingly, when preparing statement of cash flows, only transactions that affected cash and cash equivalents are reported in the statement of cash flows. Non-cash transactions, on the other hand, are excluded and disclosed only. Entities except financial institution may classify cash flows on interest and dividends as follows. First, interest income received. When you receive interest revenue, an income happened. Therefore, it is an operating activity. And when you receive an interest income, meaning you let them borrow your money or you have investment. Therefore, it could also be an investing activity. Second, interest expense paid. It could be an operating activity because operating activities include cash inflows and outflows on items of income and expenses. And it can also be an indication of borrowings, therefore it could also be included in financing activity. Third, dividend income received. You receive a dividend income because you have investment, therefore it could be an investing activity. And it is also a revenue, therefore it could be an operating activity. And lastly, dividend paid to owners. These are payment to owners, therefore it is a financing activity. And it can also be an operating activity because it could be a determination of profit or loss.
Now, I'm going to discuss the difference between the direct method and indirect method for preparing the statement of cash flows. The investing and financing sections are the same. They are identical. It doesn't matter what you use, the direct or indirect method, while the operating sections use direct or indirect method, but difference is how the operating section is prepared. I am going to focus on operating section for this sample company. We have a comparative balance sheet and income statement. These are the numbers that being used to prepare the statement of cash flow. For the direct method, what we are doing this is we're gonna go to the income statement. We take all items in the income statement one by one. We're going to convert it to cash basis. But the depreciation expense does not appear on a cash basis because it's a non-cash charge. You won't see it in the direct method. On the other hand, indirect method is what most commonly used. We're gonna start on the net income from the income statement, and then the rest of the operating sections will undergo adjustments to reconcile net income to cash flow of operating activities. We start on 32,000 of net income, then look for the current asset and current liabilities from the comparative balance sheet. We also have a non-cash charge like depreciation expense. This depreciation expense reduce net income. Before thinking, this depreciation expense is not in the net income. We better add back the depreciation expense added to the net income.
So here's another example of statement of cash flows using direct method and indirect method. Again, the direct method uses actual cash inflows and outflows from the company's operations, instead of modifying the operating section from accrual accounting to a cash basis. And in indirect method, the non-cash items must be added back to reconcile the net income to actual cash flows from operations. The Philippine Accounting Standard 7 Statement of Cash Flows encourages to use direct method. But in real practice, they use indirect method because it is much simpler because most companies keep their records on an accrual basis.